People are beginning to worry about this being the end of a cycle. It's been a long economic cycle. If we get through to the early summer of next year, it will be the longest in over 100 years. But we think that's very likely. We think the economy will grow, but at a much slower pace. So it started this year growing at an annualized rate of about 4%. By the end of next year, we think it will be growing at around 1.6, but still positive. And if the economies are positive, profits will still grow, albeit at a slower pace.
Why are equity markets acting like we are going into recession?
Well, I think there are a few points. First of all, there are some significant uncertainties which markets are focused on. In particular, the stress we're beginning to see in high-yield credit, concerns about world trade, of course, in Europe, political risks related to specific issues. But fundamentally, I think what started as a worry about rising inflation and interest rates late in the summer and in September has really morphed into a concern that we are at the end of the cycle and growth is going to come down a lot. And importantly, profit growth is going to come down a lot. And I think that's what the markets are responding to.
I know it doesn't make a good headline in the media, Peter, but I mean, let's be honest. The reason stocks go down is because more people want to sell more badly than more people want to buy. I mean, that's it. But we always try to find a reason why people either want to buy or sell. At Goldman, you guys have probably better data than anybody else. Why do you think people have been so eager to sell U.S. equities?
Well, in part, of course, fundamentally, there's this expectation of a slowdown. If we go back to earlier in the year, particularly in the US, as the market was making gains, it was getting quite expensive. And also, of course, cash is becoming, particularly in the US, more competitive as an asset class. I think it's also worth stressing that many many investment funds have had very concentrated positions in parts of the market that have been winning for long periods of time. And that meant that as the market came off, there was aggressive selling in lots of the same parts of the market, and that's created its own little mini vicious cycle. But I do think it's worth emphasizing that in the context of this sell-off, valuations now have come down a long way. Globally, equity valuations have fallen around 20% over the course of this year. And so excessive valuations is now not really the major concern for equity markets. It's more about where profits are going to go from here.
I'm interested in your words, mini vicious cycle, Peter. Makes it sound like you believe this could be short-lived. Mini.
Well, I think that if we look at the fundamentals, we believe that global growth is going to slow next year, but still be positive. The slowdown is going to be sharper in the US, but from a stronger base. And we do think that profit growth is going to slow. If you take the US, profit growth has been over 20% this year. We think it's going to slow to around 6% next year and around 4% the year after. In all the major regions of the world, we think that profit growth is going to be around 4 to 6%, so quite low. That reality of a slowdown in profit growth and in activity economically has really been at the heart of this sell-off. But a lot of the technical factors which have accelerated the speed of the selling, I think, are temporary. So our view is that we're still in an upward trend, both for the economies and for equity markets, but the overall growth rates are going to slow, and we should expect a relatively low return in equity markets globally next year, but still positive.
Before we let you go, give us one piece of sound, sage Goldman Sachs advice on what our viewers and listeners should be doing with their money right now.
Well, I do think that it's important to emphasize that without recessions, it's very unlikely that corporate profits actually will fall. And without profits falling, it's very unlikely that you'll get a sustained bear market. So I think this has been a sharp correction as people have worried about a slowdown in growth. Valuations have now improved a lot. And I think in the context of that, people should look longer term and recognize that there are some value opportunities emerging. We shouldn't expect the strong returns that we've seen in recent years, but I still think that equity markets will make progress moderately over the course of the next 12 months.